The next thing I want to talk about is the power of depreciation. So there's very few things that you can add back as write-offs on your taxes, but a big one and the main one is depreciation. Um, so depreciation is a non-cash expense that lowers your taxable income, but it doesn't touch your actual cash flow. So mortgage lenders can add back certain types of depreciation to your qualifying income, especially on Schedule C, E, 1065S, and 1120S tax returns. Um, an example of things that would be depreciation, or maybe industries I see a lot of depreciation, a trucking company, for example, buying trucks every year, doing, writing that off as depreciation, that could be a big expense. Equipment, uh, you know, real estate investors, different things like that. Um, Industries where I see it doesn't really work, or things where you just really don't have a lot of, uh, well, equipment, you know, hairdressers, consultants, white collar type jobs where you're working out of your house. Um, you know, Really very hard to find things there. Um, another thing to think about, uh, if you can't, find enough expenses, is doing something called cost segregation. And this is an advanced strategy that really I've just kind of come across. But think about this: if you own an investment property, you could hire a specialist to break your building into components that depreciate faster. So think appliances, fixtures, landscaping. This is cost segregation, and it could give you a lot of money in deductions without, uh, you know, reducing your actual cash flow. Um, a lot of times you could take this strategy and, if you think about, I guess it was 2017 where um, they allowed people to take bonus depreciation, and that's been phasing out, I think, 20% a year, and I think it goes out completely in 2026. So that was where you could buy, say, a truck and write off the whole thing the first year. This is similar to that, where instead of depreciating something over, we'll say, 26 years, maybe you depreciate it over 5 years. And so, long story short, you're able to boost that depreciation that you can put into your tax return, which is going to increase the amount of income that you can use for a mortgage. So if you have any more questions about that, put it in the comments. Frankly, I'm not a specialist on that, so I would like to get some more information on it as well. But but it's something I think could really help. Um, the the thing to do, let's say if we do all of these things, we tried everything, and we can't get any more income. Many times, and I do a lot of these types of loans, it just doesn't work. I have several loans right now. Uh, One gentleman, we basically tried everything. The nature of his business, it just didn't work, no matter how we looked at it. So in that case, if there's no other way to do it, then we might use something called a no ratio loan. So if you put 30% down, you have at least a 680 credit score, and you have 6 to 12 months of mortgage payments and reserves after closing, you don't have to put any income on the tax return. That's a sort of higher interest rate option, but it works. Now, if you can use your business bank statements, say your last 12 months of business bank statements, and depending on the nature of your industry, depends on how much of those the deposits we can use. We take an average deposit over 1 year, then that would be good. So 50% of the deposits is the general amount we can use. And if you're in like I had a lady last year, she was a consultant, so we were able to use 80% of the deposits. That worked out great. Now, if you're in a line of work where you receive a 1099 or multiple 1099s, we could take 90% of the 1099s, and that's your income. And then there's also other options where you could use a non-audited profit and loss statement, where a tax preparer, as long as they sign off on it, that's another way to do it. But again, these are all options that have higher interest rates, minimum of 10% down payment, and but they work. Use them all the time. I would say, for a final sort of overview of what we talked about here, it's the first quarter of the year. Before you file your tax return, talk to your accountant. Think about ways where you could possibly use things like depreciation to boost your income for mortgage qualification. Another tip is, if you've been in business over 5 years, you can use just your most recent year's tax return, typically for a conventional loan. That way you don't have to drag the loss from, say, 23 into 24. Avoid amending your tax return during an underwriting process. That's a big red flag. Yeah, if you have any questions, I hope you found this video helpful. Please click like and subscribe. Feel free to go to my website, mortgagesbyscott.com. If I can help you with a mortgage, I lend in many different states now: North Carolina, South Carolina, Florida, Georgia, New Hampshire, Indiana, Arkansas. Reach out to me. Love to help. Thanks for watching, and please stay tuned for my next video.